Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. Three iconic companies, General Electric, Johnson & Johnson and Toshiba, recently announced that they will each split into multiple entities. This has raised serious questions about the future of multidimensional conglomerates in India as well. So should large business groups which share many similarities with traditional conglomerates around the world reconsider their organizational structure? Or do the demands of an emerging market like India require them to adopt a different approach? Let us attempt to answer this crucial question in our next report.
Conglomerates and the demerits of being one are once again in the news. This month, General Electric broke up into three public companies. Experts suggest the development was long overdue. General Electric's revenue for 2020 was $79.62 billion, a far cry from the $180 billion plus revenue it booked in 2008. In India too, Vedanta took a similar call of restructuring. Market imperatives obviously drive such decisions, which is why conglomerates have come to be regarded as dinosaurs in the Western world, a relic of a bygone business climate that favored such company structures. Diversification into multiple businesses was once considered to be an effective way to mitigate risk. The logic was that when one industry was in a downturn, another might be thriving. However, this strategy doesn't have many buyers today, at least not in the West anyway. But as former Business Standard editor Shyamal Majumdar pointed out in his latest column, conglomerates continue to remain relevant in emerging markets such as India. Majumdar highlighted two important reasons. First, there are too many dwarf companies that fail to make an impact because of scalability issues. And second, diversified business groups have the advantage of low-cost capital, as money earned from performing businesses can be invested in new businesses, which have the potential to become hugely profitable over the long term. While on the flip side, even among Indian firms, there is the view that moving away from the conglomerate structure could actually unlock great value. That is what Anil Agarwal-led Vedanta is counting on. About the plan to break up the conglomerate, Vedanta chairman Agarwal said, "This step, whilst pending a detailed evaluation, is designed to create independent, industry-leading, global public companies, where each can benefit from greater focus, tailored capital allocation, and strategic flexibility to drive long-term growth and value for customers, investors, and employees." Similarly, a Bain & Company study on conglomerates in India and Southeast Asia suggests that the advantages traditionally associated with conglomerates don't seem to hold true anymore. The report says that these large firms have begun to underperform in revenue growth and margin improvement.
The biggest lesson that Indian companies should learn is that if you are a conglomerate, the main holding company must be able to prove that it is worth more than the sum of its parts. Now, conglomerates, many of them Indians, and there are some in other countries as well, they continue to justify their structure as necessary to maintain business relationships. But if you look at the increasing number of sophisticated investors like private equities and others which are coming in now, they treat this kind of structure as a recipe for low returns on equity and poor corporate governance. Unless conglomerates in India reinvent themselves, investors will call for breaking them up. That there is absolutely no uncertainty on that front. Now, there must be a clear transformational roadmap in which they excel. Without that, and there should be a clear and compelling ambition that powers their existence as a conglomerate.
Nirmalya Kumar, Lee Kong Xian Professor of Marketing at Singapore Management University, believes that the nature of India's business groups and business environment and their peculiarities will also decide whether conglomerate-like structures persist in India or not.
The question of conglomerates in India is a very interesting one. While it may seem that India has a lot of conglomerates, technically what we have in India are what we call family-controlled promoter business groups. These business groups, while they look like conglomerates because they both have a lot of unrelated businesses within a portfolio, they also differ in significant ways. In a conglomerate in the West, the mother company is listed, but the daughter companies, like in a General Electric, are unlisted. As a result, the General Electric can pursue win-win as well as win-lose synergies between their companies because the minority shareholders are the same. In family-owned business groups, where there are many unrelated businesses within the domain of a mother company, the mother company is unlisted, whereas the daughter companies may be listed or they may be unlisted. But because the minority shareholders of these daughter companies are different, technically, a business group can only pursue win-win synergies and not win-lose synergies. Now, of course, in practice, we know this is not true because generally the cash flow of one or two winning companies in each family group supports the losing companies with not only cash flow, but also with certain related party transactions. Now, the question becomes that in the future, what will happen to these business groups? And the answer in India for the moment seems to be that they will persist in the future. And there are a couple of reasons for this. The first reason is that there is very low performance discipline in India against losing promoter-held companies. And the reason for that is partially driven by the fact that there is a close nexus in India between the promoters, the financial investor community, like the banks, which are private or public, as well as corporations like the Life Insurance Company of India, which are controlled by the government and are active investors and shareholders in these promoter-held companies. And the promoter, in a sense, these shareholders allow for poor performance in some of these promoter-held companies to persist for a long time without demanding a change in management or ownership structure. The second reason why these family groups persist with these unrelated businesses despite any performance differences is because generally the promoter has more than one child, and when the time comes for inheritance, they want to be able to leave one company for each of their children so that the siblings can play the role of CEO and chairman without getting in each other's way.
There is another line of argument in favor of conglomerates. Former Planning Commission member Arun Maira believes that with the right management capabilities in place, conglomerates could enjoy certain advantages in the long run, although they might not necessarily be financial or operational in nature.
Having a diversity of companies in a conglomerate which need not even trade with each other, but which are all on a learning mission to improve their core capabilities with respect to matters such as building talent inside, improving the interactions within the company to be faster learning organizations, to all of them learning how to win the trust of the communities around and the environment around themselves. Now, these are the intangible capabilities that more companies are going to need more of in an uncertain world as we are in now, is winning the trust of people who work inside, winning the trust of the communities on the outside. And these abilities can be learned from each other, even if you're doing very different businesses. So if you see the conglomerate as a learning system, then you can see the value to all the companies in the conglomerate, as well as because their progress will be more sustainable. They are more resilient in an uncertain world. There is also a greater guarantee that their returns from these conglomerates or companies within these conglomerates will be sustained over a longer time. So in the short term, in the medium term and short term, maybe one may go up and down, but in the longer term, all of them, because they are supporting each other and improving their core capabilities to be the best at those core capabilities that all companies are going to need more of in the world now on, it's an advantage to be a conglomerate.
It will be interesting to see whether well-known Indian groups, such as the likes of the Tatas and the Birlas, will re-examine their organizational structures.
While experts in the West might have reached their conclusions, clearly the debate for and against conglomerates continues, at least in India. But moving away from conglomerates, a handful of smaller, independent, and homegrown distilleries in India are brewing the success stories in different parts of the country. They're catering to the ambitious young Indians who also want to try local and handcrafted premium booze. So, several new age liquor brands have emerged in India with a focus on the quality of their ingredients. This report takes a look at how the story is unfolding and what lies ahead.
India's alcohol consumption pattern has been dominated by brown liquors like whiskey, brandy, and rum. But the past few years have seen the emergence of several craft liquor brands led by gin, a white spirit. A slew of small, independent, and homegrown distilleries born in the last 2 to 3 years in Goa are leading the race. The tiny tourism-driven state has become a fertile ground for experimentation for the country's fledgling craft spirits industry. India's first craft gin producer, Now Spirits, was founded in 2015. The company's two brands, Greater Than and Hapusa, have marked their presence now. Then came Stranger & Sons Gin in 2018 from Goa-based Third Eye Distillery and Matinee Gin in March 2021. These are just 3 of the dozen small gin brands that have launched recently. To understand India's wider craft spirits landscape, we spoke with Vikram Achanta, co-founder and CEO of Taliho, a beverage education consulting and training firm. As the gin space became a tad crowded, new launches in other categories are now making their mark.
I mean, typically what we would define as a craft spirit is something which has a certain high level of quality to the product, which is produced, say, in a small batch, so not in a large scale or in a mass scale of production. And definitely there would be when I say quality, it also comes from the kind of quality of ingredients that are being used, as well as the time and the process which is used to make that particular spirit. There may be also an element of hand craftsmanship or the human touch. So in that sense, in the Indian spirits landscape, the original pioneers, shall I say, are the single malt companies such as Amrut and Paul John, They really gave the rest of Indian spirits entrepreneurs the power to dream that they can build a world-class spirit out of India and take it to the world. And that's what these companies did. Their success is what led to the next evolution or jump, which is the typically first or second generation entrepreneurs entering the craft gin space. Subsequent to that, we've had people come into other categories. Premiumization is very much the name of the game in the spirits industry in India. I think the outlook is very positive given the kind of consumer response that these craft spirit producers have received in the gin space to begin with. So I think that the response on the offtake is very positive.
Investors are helping these brands find their feet. Rahasya Vodka, founded by Varna Bhatt in 2020, received Rs 2.5 crore in seed funding in August this year. The company behind Makazai Rum, founded by banker-turned-entrepreneur Kasturi Banerjee, has also received angel funding of more than Rs 2 crore. Now Spirits, which makes the now popular Greater Than and Hapusa gins, raised Rs 15 crore in its Series A funding round early this year. Craft liquor brands pride themselves on being entirely homegrown, with ambitions of taking the brand global. Their focus is on slick design, attractive packaging, and backstories that fit their brands. Varna Bhatt, who launched Rahasya, says there wasn't a lot of movement in the craft vodka space, which prompted her to experiment. Rahasya is supposed to invoke nostalgia with its Indian infusions. Varna Bhatt says each person experiences the infusion in their own different way.
Very honestly, the idea of Rahasya was less a vodka, but more a drink that will relate to every household in India where people enjoy drinking, right? And understand the nuances of what it is to have a good, amazingly infused product with really good quality drinks, and something that's smooth, something that's palatable, something that fits with the Indian identities that we all have. If you are an Indian, you'll relate to it from its Indianness. If you're not an Indian and you visited India, then you will remember the exoticness of it. We didn't expect to grow this fast. We didn't expect the market to come back asking for so much more. We thought we'd need to educate them much more than what we are. But the crowd today is very discerning. They're very pro good liquor. To be honest, it's been beyond what I expected. We're hoping that over time we build the loyalties for our product. It's not a thing that will happen today. It's going to take its time. But we're here for the long run, and we'd like to see how the consumer accepts us more and more.
Kasturi Banerjee, the founder of Makazai Rum, says that India lacked a premium rum option, though it is a popular drink. Her Makazai Rum is not made just for cocktails, but is also meant as a sipping drink.
India is more specifically bent towards brown liquids, which is whiskey, rum, and brandy. And I always felt rum had all the qualities, but was never represented well in the premium category. Where we differentiate ourselves is we are totally homegrown. Every part of the bottle is from India, right from the caps to the bottle to every ingredient that goes inside the bottle. The second part is gold rum. That's not very heard of in India yet. Why we call it a gold rum is it's a blend of a 2.5-year-old cane spirit. The color that we have is not artificial. That is the color the liquid extracts from the cask, the oak cask that we age it in. The gold rum is a sipping rum. That's again a new concept. People usually drink their rums with a lot of mixers. There is a palette for every drink. So it is not an alternate. It's not a competition. It is just another choice for the audience. So the consumer is extremely vibrant today. It's no more that I drink this and I'm going to keep drinking this. They're open to experiment. They're open to know what is going inside their drinks, As a small brand, we've really, I think we've done well. The future plans are definitely to expand to 1 or 2 more markets by the end of this financial year. And we would definitely want to export a few cases. That would be great.
India is one of the highest liquor consuming nations of the world. With the rising income levels, people here are also exploring premium brands. Craft liquor brands are seeing an opportunity in this growing market. They are clearly setting a trend for more innovation to follow in this exciting field.
After falling the most in 7 months, the benchmark Sensex index oscillated over 1100 points in intraday trade and ended higher for the first time in 5 days on Tuesday. The Nifty 50 index also gained 0.5% yesterday, but will this recovery sustain amid global headwinds, or will bears dismantle this rally yet again? What are the stocks that you should keep in your portfolio to ride this volatility? Let's find out.
After Tuesday's remarkable rebound, investors will monitor the indices movement today to judge whether yesterday's recovery was a dead cat bounce or a resumption of a sustainable uptrend. The BSE Sensex bounced back over 900 points from the day's low yesterday to end nearly 200 points higher at 58,664. The NSE Nifty, on the other hand, bounced back from a low of 17,200 to end above 17,500 mark. On tech charts, the sharp reversal resulted in a bullish candle on daily charts, suggesting further upside from the current levels. That said, the scheduled derivatives expiry of November future and options series on Thursday may keep the markets volatile today. Strength in the US dollar, news flow around rising COVID-19 cases globally, and movement in commodity prices are some of the other global headwinds that may keep investors cautious. Back home, analysts say the speed of the market rally is going to slow down now as we are entering the next phase of the bull market, which is going to be much more measured and selective. So which stocks look attractive on charts? Let's find out. According to tech charts, 5 large cap stocks, Cipla, Maruti Suzuki, UPL, Power Grid, and Tech Mahindra are trading in the oversold zone. In the near term, these stocks will likely witness a sharp rally from the current levels, provided the overall market sentiment stays positive. Shares of Maruti Suzuki, for instance, are expected to see a 14% rally, and the stock may hit the rupees 9,000 mark in the near term. Those of Tech Mahindra and UPL, on the other hand, can see a 9% and 10% rally respectively. Power Grid and Cipla, meanwhile, may rise up to 8%. Apart from these large cap stocks, investors may also consider investing in recently listed latent view analytics shares, albeit at lower levels. The data analytics firm made a strong market debut on the bourses on Tuesday and listed at 530 rupees per share on the BSE, a 169% premium against the issue price of 197 rupees per share. The firm's maiden offering had garnered 339 times subscription, making it the most subscribed initial public offering ever. Going forward, analysts advise short-term investors to partially book profit as valuation post a stellar listing pop look expensive. Santosh Meena, head of research at Swastika InvestSmart, for instance, says aggressive investors should hold on to the stock, while those who played for listing gain should keep a stop loss at Rs 490. Moreover, analysts say new investors should wait for correction to buy the stock, as data analytics is one of the fastest growing areas and latent view has emerged as a niche player offering services at a global scale.
The country's march towards the digital economy gathered pace in the last 2 years, especially during the period marked by the pandemic. And online payments led by UPI transactions challenged the monopoly of cash. But at the same time, the country also witnessed a jump in online payment frauds. Our next report takes a look at the ways fraudsters operate and how you can protect yourself from them.
The Reserve Bank of India in its annual report said that COVID-19 pandemic fueled the proliferation of digital modes of payments. As money grew on virtual platforms, so did the tech-savvy fraudsters. According to the National Crime Records Bureau, the cyber crimes saw a surge of 12% last year. And just like the real world, the law enforcement agencies are on toes to curb frauds in the virtual world too. And if you thought that just the elderly and technically challenged people fall prey to cyber frauds, then you're mistaken. Seasoned fraudsters who work full-time to cheat people have spared none. Let us see what methods these fraudsters adopt to swindle money. As the maximum financial transactions take place through Unified Payments Interface or UPI, this platform witnesses the most attacks. The fraudsters use a basic feature of UPI apps called Collect Request for cheating. The Collect Request feature on UPI apps lets you request others to pay you a specified amount. This type of fraud is more prevalent on platforms like OLX, Quicker, and Telegram. Assume that you are a seller who just listed your phone for sale on OLX. The fraudster will call you to show interest in purchasing the phone. He may even insist on paying in advance even without taking a look at the product. And in the next step, he will send you a UPI collect request after taking your phone number or the UPI ID. The scammer promises to transfer the money to you, but instead sends a request demanding money. But the unsuspecting seller, thinking that it is a request to accept money, approves it, following which money is debited from his account. The most important thing to remember here is that receiving money via UPI takes no effort and you are not required to enter a PIN for that. Sometimes the fraudster may also send you a collect request in the form of an image of a QR code and ask you to scan that in order to receive money. One need not even open the UPI app to receive money. If you receive such a money request, you can simply decline it. Another popular method of fraudsters is to pose as bank officials and cheat people by gaining remote access to their mobile phones through an app. In this scenario, a caller tells you that your KYC is invalid or that your debit card is blocked. He then asks you to download an app on your mobile phone through an external link. Once you have installed the external app, the scammer can see and control your phone through it. And in a matter of minutes, the fraudster empties your bank account using your credentials. He will also be able to see the OTPs that you may receive for these transactions. Cybercriminals also use fake apps which look very similar to the official app of a bank or a company. So, never click any external link sent by to install such apps. It will share your sensitive data that will allow fraudsters to steal money. Install apps only from the Google Play Store or the Apple App Store. Not just this, cybercriminals use sophisticated phishing attacks by designing websites that look similar to bank websites. Links to such sites are sent as SMSs and emails to customers. Customers are then persuaded to enter sensitive information, including internet banking credentials, which is used to make fraudulent transactions. So, users must verify the URLs of the website more than once to stay safe. Always keep in mind that financial institutions will never ask for sensitive customer information such as OTPs, debit card or credit card details, card security code, and UPI ID or PIN. And if you realize you have been cheated, alert your bank immediately, as that may help in recovery.
And that's all we have for you today. We'll be back tomorrow morning with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.